Can you really get paid every single week? Today we're breaking down my $10,000 dividend portfolio. No confusing jargon, just simple beginner-friendly strategies for passive income. Tap that subscribe button. Let's grow your money together. Hey, and welcome back to the dividend portfolio. Today we're going to do our weekly wrap-up. We're going to start with Rex shares. So Rex shares is up just a little overall. Here's the portfolio value. If you're new to this, we have Rex shares, Roundhill, 2 YieldMax, Defiance, and Granite shares. Those are the weekly pairs. And then aristocrats, index funds, monthlies, and quarterlies are stocks and ETFs. And I go over those in a separate video to keep these a little shorter. So we're going to start off with this one. And as you can see, CWII is the winner of this group. And that is mostly share price. As you can see, it's gone up from 1092 to 1575. So we're getting a 30% return. NVII, as you can see, it's from 25.15 average cost. It's up to 27.65, but its return is over 100%. So let's take a look and see why those two numbers are different. So this one, you have a 15.75 price and you're getting a 9-cent return. And on this one, you have a 25 or 27.65 and you're getting a 60-cent dividend. So this one will be a little higher. As you can see, it's kind of dropping. This is actually up. Oh, yes, I remember why this one's up so high. Let's go back and look at its history, and you can see it's had this payment of 60, and it's done this in the past. It had a big jump here, and it had a big jump back here. And as you can see, it has these big payments of like 2 to 3 times normal, and then it drops back down to around 15 to 20 cents. And then it did it again, and now we're on another big payment. So that's why that number is going to be high this week. And if history holds, you'll see it drop back down to around 20 cents over the next 2 payments. So that'll be something to keep an eye on. But it's nice to know that they do have those big payments once in a while in this fund. I don't think CWI does that. That one's more steady. As you can see, it's around 10 cents. Yeah, 13 to 8. So it's around 10 cents and it doesn't fluctuate much. There are no big hits in this one. So when you're doing weeklies or actually any dividend, you got to kind of look at the history of it to see if it's paying special dividends or it does something like that once in a while. But of course, CWII has had the nice share increase in price also. And the other one in the green is HOII, and that's only up from 1135 to 1166, and that's a 23% return currently. Roundhill. Roundhill's up $35,000, and we are about 3 months into this. And I'll show you, most of it is with ARMW. As you can see, the average price is $27.63, and it's up to $99 a share. So all that has been a huge, huge return on cost. So you can see here's its price. I mean, it was down here at $21, and then it slowly, and then it just exploded the last few weeks. Its dividend has been going up with the price, but the yield it looks a little low because the price or the return on dividend doesn't keep up with the price increase. As you can see, it was 30, then jumped to 40, 50. We had a one good dollar, and then it dropped back down, and it's up to $1.60 again. So as the share price increases, I do look for the dividend. It should, if they're running it correctly, your dividend should go up a little bit also. But you never know, because sometimes the way they write these covered calls don't always work out that way. Let's take a look at a normal one, AVGW. That one's up from 41 to 55. It's paying a 35% return. This one's 30% return. It's gone from 39 to 49. So let's take a peek at that one's dividend, 28 cents. As you can see, historically, it's been a little better. Yeah, it's a slight dip currently, and then it's recovering. And you can see the payments have dropped from around the 30s, mid 30s. We had a 40 and then it fell off by 15 cents. So it's on a slight decline right now. And, that happens with these weeklies. It's so hard to predict what they're going to happen. The timing on when they write the covered calls has a lot to do with it. And with doing it every week, it's really hard for them to get any kind of consistency. But the portfolio overall is doing okay, like I said, but most of that is one return. So if we took this one out, that's 32,000 of profit out of the portfolio. So how these worked, if you want to know where we're doing overall, we started with $10,000 in each fund or stock or ETF. And so that way you can quickly look at the market value tab, and that tells you where you are against your initial investment. And then the cost basis is taking into account the dividends received. So even though this one says you've lost $512, you are still over $500 over your initial investment, and you haven't put any more money into it. What you've lost is money against your dividend return, which still isn't good. You'd still rather be in the green, but as long as you're holding your value here and your shares are growing, hopefully they will get to a point where your individual fund, the share price starts to tick up, and then your returns will be exponentially higher because you have more shares. Or you can just trade out of a losing one and move up to a winning one. But I like this one. I don't know that I would buy on something that's on that much of a hot streak, because remember, it could return to its normal price of $30 just as fast as it went up to $100. So that is something you'll have to decide for yourself. Me personally, I don't like chasing things that are screaming high like that. I wouldn't jump in now. That's just me. I would do one of these down here where you're going to get some more consistency and you're going to get share price appreciation. YieldMax Group 1 looks like it's up a little. This one's up. Chippy, CHPY, has had a good share increase from 56 to 85. GPTY is 38 to 50. You had a 21 to 24 for LFGY. 39 to 43 for QDTY. So they've had some decent appreciation of share price. What are the returns? You can see the biggest return is this one. Looks like it's down a hair today, but paid 25 cents in its last dividend. And that is very consistent. You can see these dividends really haven't jumped between plus or minus 1 to 5 cents. You had a 1 negative 13 right there. But other than that, there's more red. So it has dropped from around 30 to around 25, but it's up over the bottom. So I like that one personally. Any of these others doing anything exciting? We got a 60% on YieldMax. It's a 8.78 and it pays 9 cents on the dividends. So that's why the yield is a little higher. Sometimes on these lower cost stocks, your dividend is, look at that, 8-9 cents seems to be consistent. Had a 10, 8, 9. So what that does is that makes that return look a little better. That's why it's up at that 60%. And like I said, it's only an 8.39. So this is something that you could, if you had a small amount of cash, like $100 or so, you could throw it at that and kind of use that as a long-term. And when I get to Granite shares, I'll show you the danger of the low cost ones. But for now, as long as the price is still staying steady and or even increasing slightly, you're generally looking for that to be a long-term hold as long as the price keeps going up. This one is down quite a bit. This is the largest holding, and that's why it takes a second to load, but YieldMax Group 2 has the most in it. As you can see, it's a very big portfolio, so you have a lot of losses. Roblox, RBLX. I actually did a covered call on that a couple weeks ago, and I got lucky. I hit it while it was, I hit it on a jump, and my shares got exercised. So I made profit on the shares, and I made profit on the call. So that was fun. AMDY. So this AMD has been doing really well on the stock. So that's why the value of this one has jumped. Morrow, that's another. It was down to 575 and it's up to 687. I personally hold that one for disclosure, and I bought it because it was down here, and I just bought a handful of shares. Any of these others huge? No. Let's. HIYY seems to have a nice return. It's up. It's flat today, 24 cents on a $15 stock. So anytime this number is good comparison to this number, that's how you're going to look at that. That's a 101, so it's over 100% and 82% trailing. It is slightly below the 7-month average, but not much. So this chart kind of shows you the inconsistency of the dividend payments. So if you want to see it in a graph form, you can see it there. And if you don't want to have to go down here, because he was down to paying 15 cents a share, and now it's back up to 24. It spiked to 30 a couple of weeks. So if it stays around the 20 cents a share, that would be fine. Defiance, 3,000. This one's okay. So let's take a look at this one. And the reason I chose this is that when I was looking at this earlier, this one is paid 8 cents, so we'll go through it real quick. And it's right there at that 50%. And as you can see, it's coming off a high, so I wanted to see kind of what's going to happen in the future with this one. But as you can see, this one normally pays around 10 cents, a little above, a little below. So this one has been really steady as far as its dividend payment. So just the share price going up and down will change that yield. Also, I took this one. So if you bought it at 833, I think is what it was when I looked at it earlier, it's gone up a few cents. But this is, you can do this in Google. You just type in, if your initial investment of $100 will grow to by 164.38. And what I did was I just took the share price. If you're a math person, this is how you calculate it, annual return with and without drip. But if you put $100 in, and here would be your 1-year return. So for just putting $100 in and doing nothing else, after 12 weeks, you would have 19.73 shares starting with 12. It would be worth $164, and you would have made $64.38 in dividends. And you can do this in, this is Google's AI mode. And then I did it for 5 years with a $25 monthly contribution. And this is if you started with $100 and every month you added 25, and I went out 5 years on this one. And as you can see, in 5 years, you'd have 924 shares and you'd be making $73 a week. So if you're going to do that, say, obviously you don't want to put all your money in one fund. So that's why I did a low amount like 100. Imagine if you did $100 in 10 different funds, and you added $25 a month, which is $250. I don't know if that's in your budget or not. But if you took this times 10, in 5 years, that would be $7,300, almost $7,400 a week in dividends. So that's something you can play with long term on your own. And now I want to go to the complete dumpster fire that's Granite shares, and here is why. You see this number? It says it's up 111,000. It's not, trust me. What happened is, you can see these prices. It went from 381 to 23. It went from 457 to 20 and 538 to 23. They did a reverse stock split, and this particular dividend tracker does not track stock splits. That information isn't pulled. So I'm going to have to go in and divide these by the stock split. And as you can see, we had a 1 for 6 for KOI. MIDI was 1 for 6 and TSYY was 1 for 8. So after this video, I have to go in here and I'm going to divide these by, I'll divide that by 8 and these two by 6. And these will all go from being huge positives to negatives because it's lost money. So that's something you do have to watch out for. And that's a good thing for having these Granite shares in here to show you what happens when you have bad shares, is the reverse stock split can wipe out everything you have done. Because see, you have 3,000 shares and you're getting an annual dividend, but you know, you lose an 1 for 8 or lose 8 to 1 of your shares. That really kills your overall portfolio. So that's the downside of buying a small value that's losing, or anything that's consistently going negative. They will reverse it. And when they reverse it, you're going to be negative for a long while. So if they announce it ahead of time, you have to decide, do you want to bail ahead of time, or if you're going to just do a long-term hold and just let it grow back and hope it grows back. But like I said, that's Granite shares, and I would never recommend that to anybody. Okay, I'm going to show you, I have done in another video, I have a covered call portfolio in Thinkorswim, and I'm selling covered calls on a variety of different stocks. And I'm taking the money I earn from the covered calls and I'm buying different stocks, or different investments from the funds I have in this portfolio. Most of these are from the weeklies. I have a couple, like I have FEPI and Trin. So I have a couple of non-weekly stocks, but I just put this together to see what would happen if you wrote covered calls and then bought different funds from the dividend tracker. So I thought that would be fun. I'll put a link to the covered call at the end of the video here in a second. I want to thank you guys for joining me today. If you made it this far, like and subscribe, and I will see you in the next video. Have a great one. Thank you for staying to the end. If you haven't yet, please give me a like and subscribe. It means the world to me and helps me make more videos. Thank you so much. Goodbye.